Have you ever wondered what the market is really trying to tell us? Beyond all the ticker symbols and the flashy headlines. There's this hidden language, a set of signals that tells a much deeper story about risk, about the health of the economy, and about opportunity. Well, that language is the financial spread, and in this explainer, we're going to make you fluent. So here's our game plan. We'll kick things off with the absolute fundamentals of what a spread is. Then we'll dig into the hidden costs that you pay on every single trade. After that, we'll explore how spreads work as these incredible market barometers. We'll even touch on how the pros use them in some advanced option strategies before we wrap it all up with your key takeaways. All right, first things first. What exactly is a financial spread? Let's break this core concept right down. I want you to think about this for a second. Every time you buy or sell a stock, a currency, pretty much any asset, there's a cost that's baked right into that transaction, one you might not even notice. And this, right here, is where our story really begins. At its very heart, a spread is just the gap, the difference between two prices. The most common one, and the one that affects pretty much every investor out there, is the difference between what somebody is willing to pay for an asset and what someone else is willing to sell it for. And that brings us perfectly to the bid-ask spread. This is the one you run into every single day. It's the hidden cost of trading, and honestly, it's kind of the engine that makes the whole market run. It's really just a simple negotiation, happening millions of times a second. The bid, that's what buyers are offering. The ask, that's what sellers are demanding. And the space right between those two numbers, that's the bid-ask spread. Now here is the most crucial point to get. When you see ads for zero commission trading, it does not mean zero cost. Your broker makes their money in that gap. You always buy at the slightly higher ask price, and you sell at the slightly lower bid price. That tiny difference, that's your cost of doing business. So here's where it gets really interesting, because the spread is actually communicating with you. When a huge stock like Apple has millions of buyers and sellers, the market is incredibly liquid, right? The spread is going to be tiny. We're talking a penny, maybe less. But for a smaller stock or during a crazy, chaotic market event, there's way more uncertainty, and that spread widens right out, making it more expensive to trade. It's a simple relationship. A tight spread signals an efficient market. A wide spread signals risk. This whole idea of spreads signaling risk, that brings us to our next big point. Spreads aren't just a cost. They are powerful economic barometers. They can tell us a ton about what's really happening under the hood of the market. We're going to look at two huge categories here. First, bond spreads. These tell us how worried investors are about getting their money back. And second, we have lending spreads, which give us a clear window into how profitable the banking sector is. Two very different sides of the economy. Let's start with the credit spread. Okay, so think of a U.S. government bond as the safest possible investment on planet Earth. A corporate bond, on the other hand, is riskier, right? The company could go out of business. The credit spread is basically the extra pay you get for choosing that company's risky bond over the super safe government one. Let's make this super real. Imagine the U.S. Treasury is offering you a 3% return for a 10-year loan. At the exact same time, let's say company XYZ is offering you 5% for a loan of the same length. The difference there is, you guessed it, 2%. That is the credit spread. It's that extra 2% you demand for taking on the extra risk of lending to company XYZ instead of the U.S. government. And that's the key. This isn't free money. That 2% is your compensation. It's your payment for shouldering the risk that, hey, maybe this company won't be able to pay you back. It's your risk premium. So what happens if investors suddenly get nervous about the economy? Well, they're going to demand even more compensation for that risk. That 2% spread might blow out to 4% or 5%. So when you see news reports about credit spreads widening, it is one of the clearest signals we have that fear is rising in the market. Okay, now let's flip to the other side of the economy, lending spreads. This is often called the net interest margin. And look, this is a bank's entire business model on one slide. They borrow money cheap, like paying depositors 1%, and then they lend it out for more, say 5% on mortgages and car loans. And that gap, that's the whole ball game. It's exactly how we gauge a bank's profitability. The wider their net interest margin, the more money they're making. It's a direct line. So when you hear that lending spreads are widening, you know what that means? It's a clear signal that bank profits are going up. So we've seen that spreads are a cost, and we've seen that they're a signal. But what if you could actually use them as a tool? Well, that's precisely what advanced traders do in the world of options. Now, don't let the complicated words scare you. At its core, an option spread strategy is just about combining two or more options trades. You buy one and you sell another one to create a very specific, tailored outcome. So, why would you do this? It's all about control. By using a spread, a trader can precisely define their maximum possible loss. They can reduce the amount of cash they need to put up for a trade, or they can build a position that only makes money if the stock stays within a certain price range. It's like financial engineering. And the playbook here is absolutely huge. You've got everything from simple call and put spreads for directional bets all the way to really complex strategies like butterfly spreads, which can profit if a stock doesn't move at all. And then you have things like calendar spreads, which use options with different expiration dates to profit from this simple passage of time. Each one is a specialized tool for a very specific view on the market. Okay, we have covered a ton of ground here, from simple trading costs all the way to complex strategies. So let's boil this all down to the things you absolutely have to remember. If you remember nothing else, remember these three things. A spread is, number one, a cost. It's the unavoidable price you pay to trade. Number two, it's a signal. It's your barometer for risk and economic confidence. And number three, it's a strategy, a sophisticated tool for managing outcomes. Cost, signal, strategy. Got it? So I'll leave you with this final thought. The next time you hear a news anchor say credit spreads are widening, it's not going to be just noise to you anymore. You're going to hear the market whispering that fear is on the rise. You'll finally be reading that hidden language of finance. Thank you for watching. If you got something from this, please like the video and support the channel by clicking on the subscribe button. That really helps us. Thanks again.